some news. News and reviews. Let's see what's going on in the financial world here. Anything interesting? Wong touts OpenAI deal as biggest AI infrastructure project ever. Apple positive for 2025. I can't figure that one out for the life of me. There's like nothing. There's like no news on Apple, and it's going up. It's just bizarre. Home builders needed a rate cut. They got one. Not enough. Tesla's been ripping. How about that? Mm-hmm. All right. Oh, what's DAF? I don't know what that is. More like daft. All right. So let's see. Let's get the chat going, y'all. Boom. Hey, what do you think about Grab stock? Someone had asked about that last time. That's not one that I've looked at. I'll pull up the Cap IQ on it. It looks like Cap IQ is definitely a significant fan. So let me go to that. Grab. Yeah, someone asked about last time. Maybe you were the one that asked about it last time. Yes, it says an outperform rating, but oddly enough, you don't see like a crazy valuation on it, right? So the median 623, it closed at 645. Again, I'm not like super familiar with it. Let's see what the tear sheet says. Super apps. Okay. So it's kind of like a Grubhub. Interesting. I wonder if they're a filer in the US or if they're an ADR. That would be a good question. Oh, sweet. Share that. Thank you. Appreciate it. Love the name, Chandler Bing. Let me see. Grab Investor Relations. Yeah, they do have SEC filing. Let's see. I'm just going to open up the 10K and start ripping. See what we can find here. Huh. So yeah, definitely delivery in Asia. 20F. Okay. So this is similar to like an Alibaba. So they're an ADR. So they're going to file semi-annually. Let me share this so you can see it. Window. Yes. There we go. All right. So just looking at this is Grab, everybody. Interesting. Domiciled in the Cayman Islands. Tax purposes, obviously. Let's see. Key information. Sounds like something we should look at. Our business is still in a stage of growth, and if our business or super app platform does not continue to grow or grow more slowly than we expect, fail to grow as large, blibbity blobbity, face intense competition. Okay. Interesting. Yeah, lots of risk. Got the risks. Let's get to the meat and potatoes here. So again, I'm looking at Grab here, everybody. Legal and regulatory risks. What regulatory risks are there with delivery? Oh, maybe it's the app aspect of it. Grab is a household name. Okay. Not in my house. Unless you're grabbing something. But I'm John. This is like reading the dictionary. Like, what is going on here? Digital banking. Okay. Now the truth. Okay, so they're in the digital banking. Okay, this is interesting. So they have a joint venture. Yeah, so this makes a little bit more sense now because if it's just delivery, I'm like, what's the connection? But if you could like pay via the app and do a whole bunch of other things, yes. So transactions, complex technologies, failures or delays. I want to see some financials, so hang tight. Uh, Class A shares. This is very interesting. I'm guessing they're a 1231 filer. Oop, share repurchase program. Love to see that. Taxation. Okay. All right, interesting. So they give a company history, significant milestones. Commenced operations, completed the acquisition of Uber's business in Southeast Asia. Okay, now very interesting. Launch Grab for Food, Grab Social Impact Program. Obviously, that's incredibly important. The Grab for Good Fund completed the business combination, as everybody knows. Listed on NASDAQ, that's important. Majority interest in Jaya Grocer. Okay, GXS Bank. So now they're in the banking. Okay, mobility. Grab taxi. Grab car. Grab bike. Grab hitch. Grab share. For carpool and grab rentals. HEMAT. I don't even know what a HEMAT is. Motorcycles. Wow, they're in a whole bunch of things. And deliveries. Okay, so they got banking, travel, deliveries. All right, so they're rolling up a whole bunch of small players. Got it. Financial services. Grab pay, grab rewards. They are really in a lot of different areas. This is feeling a lot like Baba, by the way. Loans. Oh, boy. I mean, it's almost like someone's sitting there talking to the guy who's running this thing, and they're like, you ever think about the banking business? It's like, yeah, let's do it. It's like, okay. So let's see. It's a super app. Deliveries, mobility, digital financial services, 800 cities across 8 countries. So food, groceries, sending packages, taxis. I got some business there. 2,797 million. Okay. I'll have to dig into it. I mean, it seems very interesting to say the least. But there's obviously a big economic exposure to that area of the world, so you have to factor that into things. All right, let me go through the questions here. So, Jason, why do you think Amazon has been such a dog? Woof woof. So, Amazon's a weird one. Amazon was kind of like sideways for a while and then just like started popping and then it kind of goes sideways again. So, why do I think Amazon has been such a dog? Well, it all depends when you buy it, right? So, like year to date, here, let's just pull it up. So, let's see. AMZN. All right. Let's see our doggy. Amazon. Woof woof. All right, I'll put it up for year. All right, let me share this. Come on. I just want to share. Here we go. Zing. 18.8%. Somewhat doggish. I would say if you bought back in this area, obviously you'd be a little bit more disappointed. I ended up buying with the Liberation Day madness. So I think I actually got it at 168. I had owned it previously, but it's recovered since then. It's not parabolic, obviously. I think most investors have been concerned about the impact of tariffs with Amazon. Also, there's a lot of questions as to what they're ultimately going to do AI wise. They have Claude. They're obviously continuing to boost their cloud business, and AWS is huge. I think the issue is a lot of analysts were complaining that AWS has kind of backed off a little bit from the growth trajectory that it had historically. So that's really what it is. Whenever you have a growth stock, if like it's crazy, if it's growing at 15% and then it starts growing at 12%, people are like, what's going on? So it's kind of a victim of its own success. But Amazon's the type of company you buy it at a discount and you just hang on. But yeah, I agree. It's not going to be one of these like parabolic things. Remember, there are a lot of vendors that are, on Amazon, right? FBA, fulfillment by Amazon, that are impacted by tariffs. So that's a big part of it. But I mean, long term, when you look at Amazon's business model, I mean, just absolutely incredible. And they're making so much from advertising. I think that's the part that gets kind of lost in the sauce. They're the number three advertiser behind Meta and Google. So that's something that only opened up a few years ago as a revenue stream. So I think that that's something that's pretty fascinating. And they're trying to get away from, as much as possible, like the physical product side, focus more on the cloud, focus more on advertising. But, Amazon as we know it is definitely not going away anytime soon. Let me see what's going on with hang on, I'm going to share the Cap IQ. I have to like stop share, reshare. It's a little annoying. Yes, I want to share it. Okay. So Amazon, here we go. CIQ. Whoa. Wall Street's a big fan. 1.33 buy. Median 265. Relative to 227. I think the last time I looked at it, I had like a 234 valuation. So it's getting close to that, but I do have to refresh it. Net, Wall Street's very positive on the company, but again, is it going to be like this like parabolic growth? Probably not. And again, that's a function of the different pieces of the business. So you got to be careful with growth because it goes both ways. Look at our friend Lululemon. When you have like a little bit of a pullback, that's when all hell breaks loose. That's the problem. Hello, David. Hey, Pratyush. I am doing well. Yes. Can we get an update on your portfolio composition? Sure. I'll pull it up real time on my side because I didn't look since the market close. But I can tell you Tesla and Microsoft are pretty much the top two as the last time I looked. And Tesla's just been on an absolute freaking tear. And a bunch of people have been like going back to like the Albertsons video. Yes, I still have Albertsons. I'm still holding on for dear life. It's a dog, but it's going to come back eventually. So we got Tesla, Microsoft, CrowdStrike. That's had a nice freaking rip. That popped the other day. It was one of the ones I was thinking of analyzing. I was like, this is kind of stupid cheap. And then it just like skyrocketed. Joby. That's one that I still think has the potential to be a 100 bagger. So I'm going to stick to that thesis. VOO. You got to have some VOO. Google. I've gone through this like ad nauseum. HHH. Howard Hughes Holdings. That's Bill Ackman's attempt at creating the new Berkshire Hathaway. Meta, Celsius, Amazon, Rivian, Costco, which I haven't covered on the channel, and that's another one like Triple H. If you cover it, like nobody searches it, so I might as well like do the video and throw it into the Grand Canyon. Albertsons, STZ, Constellation, and I'm going to be adding to that position. I actually threw in some funding to do that, and then Mastercard and Berkshire Hathaway. Mastercard's an interesting one. So Mastercard and Visa literally have a duopoly in the payment space. Period. Full stop. End of story. Now, don't confuse that with PayPal. Like when I go on to PayPal, I have a Mastercard or Visa that it's utilizing. So there's a difference between like processing and like funding. So it's just crazy to me. Like you have the ability, we all have the ability to invest in a business that is literally a duopoly. Like there's only two. Very few examples like that out there. And the Cap One Discover deal, like they're so far behind. You're literally talking about 90% is MasterCard and Visa. It's pretty crazy. So those are just literal cash machines, like literal cash machines. The whole issue with those is buying them at a discount. So if you can get them at a decent discount, again, I haven't looked at either one in some time, probably like post COVID. But MasterCard's one that, depending on the valuation, I would up my exposure. And I'm actually curious, so let me pull it up. Easy ticker symbol to remember. Ma. All right, let me share. Because sharing is caring, kids. MasterCard. So 33 analysts cover MasterCard. High 740, low 520. And the close was 584.49. So let's call it 585 amongst friends. So the median 650 divided by 585. All right, 11% discount. See, that's the whole thing. Like, very hard to get it at a decent discount. I'm comparing that to the median. And then Visa, another easy one to remember. V. I wonder if that one's at any bigger of a discount. So 344, median 400. Looks like it might be at a little bit better discount. 344. Yeah, 16.3%. So again, these are like very difficult, like very, very difficult to get at a discount. But if you can get them at a discount, 20% discount. You know, you're buying with a margin of safety. I mean, again, I'm not a chartist by any stretch. But if you look at the long term for those, it's just like, those are two really good examples of companies that just go up and to the right, up and to the right. And yes, totally agree with James. You definitely got to have some VU. Oh, this is good to know. I have the perfect radio voice. Hopefully, I don't have the face for radio and the voice for television. But chum. It was funny. Somebody commented on one of my recent videos. I'm not joking. They said, "This voice is dubbed. You should trust your own voice, bro." And I was like, what? I mean, this is a podcast microphone. This is one of those Shure microphones. It's like a $300 microphone. I better sound good. But I couldn't believe it. The guy was like, your voice dubbed. Like I hire someone. Like, I'm going to hire someone to do a voiceover for him. I was like, what the? Bizarre. Huzaifa, what's going on, man? How are you? Here we go. So, would you not like to wait on STZ's quarterly report? I'm expecting the outlook to be pessimistic on the consumption demand. So, this is actually something that I was talking to somebody about STZ randomly today. And I noticed that they report on October 6th. And that's where I'm kind of stuck. I definitely want to top off my position. So my average price is like 165 or so. And obviously it's down like 133, 134. So I want a dollar cost average. But they report on October 6th. And the question is like, Are they going to report like worse, more pessimistic, stuff like that? So really the question that you have to ask yourself is kind of like the same question with a Lululemon. I think Lululemon's on the journey back. We shall see. But you don't want to like buy before earnings. They have bad news and then it's like womp womp. The real question you would have to ask yourself, or I have to ask myself with Constellation Brands STZ, is whatever they report, is it going to be so like mind blowing that it's going to go above my current cost basis? Highly doubt that. So, of the two, I would say it's probably safer to hold off until after earnings because even if earnings were like, oh my gosh, everybody's drinking beer all of a sudden again, and they're drinking Modelo's, everybody's like double fisting the Modelo's, like that scenario, I would say maybe like a 5% pop in the stock. So you'd be in like the 140s. You would still be, benefited from buying more in the 140s and dollar cost averaging. So the logic being, of the two options, you pay a little more than you would by it popping a little bit. That's much better than buying and then it goes down. So that's my take there. Um, can you look at Merck? Sure. Let's pull up Merck. I've had a lot of requests from people about various pharmaceutical companies. Eli Lilly's come up with biosynthesis, all this stuff that they're talking about. Um, so Merck closed at 80.40 and the median valuation 98. It's about at a 20% discount almost. So actually more like 25% discount because if you go to 80 to 80 to 100, that's 20 over 80, that's 25. So if the analysts are correct, that's definitely a decent enough discount. It's got an outperform rating. 25 analysts following it. I guess the question, with any pharmaceutical company, like you look at like Novo Nordisk, people are like, what do you think about Novo Nordisk? Again, the exposures to like the GLP-1 mimetics, and there's a lot of competition there. You really have to look at the research relative to like Wegovy. So there's Wegovy, there's a few other ones. I don't know. I'm not particularly in the market for that, as you could probably tell. So, it's one of those things where it's going to pop. Like another one that had a real big rise as a result of, diabetes and people being overweight and stuff was Dexcom. That was a few years ago. So Dexcom, they have like CGMs, continuous glucose monitors. Say that 5 times fast. And that stock like ripped. But again, it just like came back down to earth. So I think the real question is trades versus investments. So I'm really looking for like long-term investments that can compound for, a very long time. But I'll give you like an example. Tesla is an investment, Amazon is an investment, HHH is an investment. Those are examples of investment. You buy them at a discount, just let them compound forever. MasterCard's a good one, Visa's a good one. So let me give you some other ones that are more along the lines of a trade, which is actually going to lead us to the next question. So Celsius, I think, has a lot of runway left, but is that going to become Coke or Pepsi? No. I think the most likely thing to happen with a Celsius is that they get bought out by Pepsi, hence the partnership that they have there. I see that as a likely potential result. Which other one? Lululemon. Again, Lululemon is not going to become Nike, but at like 160, 170, do I think it's going to be back in the like low 300s sometime in 2026? Yes. So again, that's one. And again, all you have to do is, again, I'm a fundamental analysis guy. I'm not a chartist. But if you look at Lululemon, it's like this and then this and this and then this. So it's like, okay, find what point you're going to get on the roller coaster at the bottom and then get off at the top. So that would be what I would say. With even with Merck and some of these other ones, they're not necessarily like a forever hold example. Johnson & Johnson's one you could argue because they have a portfolio that's not as dependent on the actual drugs themselves. So that's where I would say you'd have to kind of look, a trade versus a long-term investment. That's kind of has to be the perspective. I mean, if it's a trade, you have to be like watching it like a hawk, which leads us to our friend Wing. What happened to Celsius? So Celsius got above like 60, 61. And I think what ultimately happened, I'll pull up the chart so everybody can see it. Um, I think Celsius is very simply an example of profit taking. Let's see. I'll do 1 year chart is very impressive. 1 year is very nice. All right, let me share it. So this is really what you'd have to look at. I think the year chart is a good example to look at for Celsius here. So if you're like, what happened? And you're looking at this like top right here, valid question. But I'm more so interested. I wish we could pull this back 2 years instead of 5 years. So just to review, okay, they were at 99 and it went all the way down to 22. By the way, we called it on this channel. I did a video at like 28, right in this area here. And I got a value of 38. I ended up picking it up at like 22 and then it just freaking ripped. Now, let me go back to the, I'll do 6 month because that's another good one. Year to date, frickin', look at this, year to date. Holy Moses, 94.9%. Good Lord. So yeah, it's just been on an absolute frickin' tear, mainly because of the Alani Nu acquisition. So Alani Nu was their closest competitor behind them, and they were gaining, and they ended up having a killer quarter. So the stock just ripped, and right now it's like, okay, let's say you bought Celsius rather at the beginning of the year. You're up 94.9%. You're like, I'm gonna take some profits. So I think that's what's going on more so than anything. I have the value as $70 on it. I'm still very positive. A few things that happened subsequent to our last video on Celsius. Pepsi sold them the portfolio of Rockstar energy drink in North America. And then they turned around and bought, for the exact same amount, they bought an additional convertible preferred. So right now, Pepsi, they increased their stake from 8.5% to I think 11%. So what they did, it was pretty clever. They said, we're going to give you $585 million, a convertible preferred. We're going to increase our stake. We believe in you. And they're like, great. And they're like, hey, do you want us to sell you Rockstar Energy North America? And they're like, yeah, sure. How much is it going to cost? And they're like, 585. So they just literally took the money back. I don't even think the money actually left hands. But the more important thing from that deal is the agreement that Alani Nu is going to be distributed in Pepsi's distribution network. So none of the numbers reflect that at all whatsoever. So you got Rockstar North America, and then you have Alani Nu being in the Pepsi distribution network. So I think Celsius still has a ways to go. And they're really solid in terms of Alani Nu on the female Gen Z demographic. And that's something that, the other energy drink competitors just haven't been able to do. So I wouldn't be particularly concerned. If you're like trading it, yeah, then it would be more of an issue. But I think the combination of Celsius and Alani Nu and now Rockstar, that definitely has some legs, and has some room to run. I haven't sold any, just full disclosure. So I'm still very bullish and positive. All right, what do you think about Hims? So I know Hims is like a fan favorite on YouTube, and I ended up doing a Hims video when it like had ripped, and I came up with a value in like the mid 30s, and the stock was at like 50, and I got like the worst comments ever. It was like, you're an idiot. I'm like, whoa, like it's like you should like you have to go back and look at the comments. They're like absurd. It's like, you should just stop your channel right now because the stuff you do is just awful and horrible and you're a horrible person. I'm like, good God, like, what the hell is wrong with you people? Like, it's numbers. It's a valuation. It's not like an indictment of like people who own the company. It's just like so bizarre to me. So net on HIMS, that is a very highly competitive space. They have no competitive advantage at all whatsoever. Like if you want, you know, hair care stuff, hair growth, there's like 10 companies that do it. And my 2 cents is that people that are in that market are probably going to say, what's the cheapest? What's the highest quality and cheapest? So, you know, the business model originally was like, you can meet online with a doctor. It's like, oh, wow. And you could get a prescription. Check this out. It's like, whoa. Like, there's 10 different companies that do that. There's zero competitive advantage. Telehealth is like a thing now. Now they were trying to get into the GLP-1s, and then that like went sideways. And now they're trying to do like compounded GLP-1s. It's like, let's focus on, you know, bald people, fat people, and balding people. Go. It's like, okay, you know, I don't think any one of those three are going away, but it's like a super competitive space. So I'm like, I don't see it. But when I did like the video on it, I was like, oh my gosh, like, holy YouTube trolls, Batman. Like, what the hell is wrong with people? So I was like, there's certain companies I'm like, I'm just never gonna cover again. Like, that's it. Hims actually qualifies as one of them because people are just like so insane about it. But what I'm going to do, because I'm a good guy, I'm going to share the current outlook on Cap IQ. Now, if I showed this to like the average person on YouTube, they'd be like, Wall Street doesn't know anything. It's a scam. I'm like, okay, yep, that's right. People are getting paid hundreds of thousands of dollars a year because they're all part of some big scam. Yep, you figured it out. Now we all know. So the latest price, 57.70, the median valuation, 45.50. I would probably have like a value right around 45, 40, 45. I mean, my value last time was in like the high 30s, I think. And I got like such vitriol and such idiocy that I was like, I'm never doing a video on this again. Kind of like Rocket Lab. I did it once. I'm like, I'm never covering this company ever again. Everybody can go pound salt. I just don't understand like the insanity. Like Intel, you know, there are a few people that I put the troll warning at the beginning of the Intel video, thank God. There are a few people that are like, hey, I'm very bullish on Intel. I'm like, okay, that's cool. And I said, hey, if the company makes it 5 years from now, it should be higher than it is today. Okay. But not a company I want anything to do with at all whatsoever. And that's the whole thing. It's all about fundamentals. Like, if you look back at the companies that we've covered on the channel, and you're like, wow, that's interesting. Ken had a video about Microsoft at 410, and now it's like over 500 bucks. Ken had a video on CrowdStrike at like, you know, 260, and now it's like 500 bucks. It's like, go look back. Go look back. There's the track record. It's like right there for everybody to see. There's nothing to hide. I even had Palantir at like 30 something dollars. The punchline is this. It's all about fundamentals at the end of the day. Nvidia, 97, I covered it. I'm like, yeah, it's undervalued. Now, did I have a valuation of 180? No, but it's like, it's undervalued. It's a buy. But like, if I were to cover Nvidia today, I'd be very hard pressed to get it that it's a discount, like near impossible after the run that it's had. You know, it's more than doubled in like 5 months. Like, okay. So that's the thing. Like on YouTube, one of the things I've realized is if you cover a stock and you don't have a buy rating, you better at least have a hold rating. And if it's a sell rating, like be prepared for, you know, Rotten Tomatoes, pitchforks. And it's just like total insanity to me. I'm just like, all right, invest in the company. Like, good luck. God bless. Like, I don't care. Like, it's just bizarre to me. It's like, it's investing in a stock. I don't get the logic. Like, if you really think you are right and I'm wrong, you should feel bad for me. Like, oh my gosh, Ken's such a moron. He's missing out on all the money he could be making in hymns. Okay, like you should feel bad for me, not like angry. So it leads me to believe that people like actually don't believe in their investment thesis and they're like, oh my gosh, like Am I making the right decision? I'll just make fun of Ken. Haha. Oh, I had paper hands and sold Celsius way too early. Oh, wah, wah. You gotta have diamond hands, bro. Come on. Just got back on Friday and today. Yeah, Celsius pulled back. I still had 70 valuation, so it was it wasn't, it was just like right on the cusp of being a buy, but now it's definitely in the buy range. I think it was below 55 something. I forgot what I said in the YouTube video. But yeah, so yeah, I'm still very positive and bullish. Uh, ooh. So this one's funny to me, Joby Aviation, because like I'm all about fundamental analysis, but it's like one of the best performing stocks in my portfolio. On a percentage basis, it's the best performer. It's like 4x. Um, so it's like, hey, see. But like when I invested in Joby, the thesis was, all right, do I believe in EV toll? Like the electric vehicle concept of like airlines, things that are going to be flying in the air, not just drones, but actually taking humans. I was like, yeah, that makes sense to me. That's going to happen. So then it's like, okay, who's going to win that race? So it's a combination of things. It's financing, it's accelerated development, and it's also the people that are backing them. So if you look like Toyota, Delta, um, Uber, like there were a whole bunch of backers where I was like, and like the executives were all they were like former Amazon. They were like really like impressive people, and they had enough cash to have like a pretty decent runway. So I was like, you know what? I'm going to throw some money at it. And if it goes to zero, oh, well. But that's like an example. I've mentioned before the book, 100 Baggers by Chris Mayer. Definitely check that out. That's an example of a company that could be 100 bagger. And I'm holding it, hoping that it will be 100 bagger. 100 bagger meaning if you invested $10,000, it would go to $1 million. But the key with a stock that's going to 100x, the biggest thing is time. You have to hold it for a long time. And to the extent you don't, you're not going to get that, upside. And again, that's where like, if you look backwards, right, hindsight's 2020. So you look backwards, you're like, oh yeah, I knew that was going to 100x. Oh, okay. Did you buy it? No, well, I was busy. I was at work. Oh, okay, got it. So you look backwards, like I think the fastest 100x was Southwest Airlines. Like, think about this for a second. 100x. I think it was a year and a half. I mean, it's just like insane. But the vast majority take like 20 plus years. And the crazy thing is there are instances like Amazon was 100 bagger twice. So the tech bubble burst, it went down. And then if you bought and then held, it went back up 100x then. So I'm positive on it in terms of Joby. Again, when you look at companies like that, you want to look at the cash burn rate and look at how much capital they have available, because it's all a matter of survival. Like I've had people troll on Rivian. I had this one guy, it was like making my brain hurt, like going back and forth in the comments with him. He's like, yeah, I really like Rivian, but I can't invest. I'm like, okay. He's like, they could dilute the shareholders like 50 to 70%. I'm always leery of big round numbers. When someone just comes up with a big round number and there's no basis for it, like that is one of my pet peeves, drives me to the brink of insanity. So like I remember in my condo, they were like, oh, we might need a new roof. And like this like dummy just blurts out, he's like, that's going to be $50,000. I turned to him, I'm like, dude, do you do roofing? Like, is that your job? Like, are you in the roofing business? And he goes, no. I go, do you know like the cost per square foot of a roof? Like, and how many square feet we have? Like, where did this number come from? This big round number, 50 grand. Like what planet did this number come from? It's just like picked out of the sky. So I'm back and forth with this guy in the comments about share dilution, and he's like completely wrong. And instead of just saying, oh, okay, thanks, he just like kept it going, and it was driving me insane. He's like, yeah, but they could dilute the shareholders without asking them, for permission to issue shares. You don't have to ask anybody permission to issue shares. You could just issue them. Like, there's no shareholder vote for issuing shares. Any company can issue shares and dilute the shareholders. Like, his argument made no sense. And he's like, yeah, but they're going to need money. And that was the most absurd part of the whole conversation. They don't need money. They have $8.5 billion of liquidity. They don't need money. And I said, if you watch the damn video, you'd see 6.6 years of runway. 6.6 years. I'm very confident Rivian's going to figure it out in 6.6 years. So the punchline, when you come across companies, whether it's Joby, Rivian, you know, all of these companies, you want to look at the cash burn rate and see when are they going to hit a wall. That's really the key. And if they do hit a wall, you know, there's numerous examples in like the EV space where it's like they don't exist anymore. Why? Because they didn't get any more funding and they're gone. Here we go. Chandler with the $1 million question. Where do you see Intel in the next 2 to 3 years from now? So just so we're crystal clear, Intel's problem is not cash. They have $29 billion of cash. Now with the Nvidia money, they have even more. They have over $30 billion of cash. Cash is not their issue. They do have $51 billion of debt. That's not good. No bueno. But they have this foundry business. They have lost operating income, $13.5 billion over the last 12 months. Okay? So let's just put this into perspective. Every chip that they're producing for other people, which is a dumb business, it's a horrible business. Taiwan Semiconductor freaking does it better than anyone. If Taiwan Semiconductor decides that they're going to do a partnership with Intel, I will like burn the boats. I will go all in, love Intel, great thing. They don't know how to run this business. They don't have someone who knows how to run this business at Intel. I'm not being like a wise guy or anything like that. So the announcement of Nvidia placing an order is irrelevant because it's a money-losing business. So let's say you sell bottles of water, okay? And let's say you sell bottles of water for 50 cents each. And let's say it costs you $1 for each bottle of water to produce it. If someone orders $1 million worth of water, you're like, yeah, no, don't cheer. You're losing 50 cents on every single bottle. So Nvidia placing this order is irrelevant. It doesn't matter. They can't produce the chips at a profit. It's a horrible business. It is a bad business. Taiwan Semiconductor knows how to do it. Intel does not know how to do it. So I actually had pulled up because I was waiting for someone. Chandler, you win the gold star tonight. I was waiting for someone to ask about Intel. And I have a video. Citigroup downgraded Intel to sell. Now you're like, wait a sec. I thought Nvidia. You say anything, either Nvidia or AI, it's amazing. It's like Nvidia dog shit. Oh my gosh, can I get some? It's crazy. Or like anything AI related. AI cancer. It's like, this is awesome. I want that. It's like, no. So let's go see what Citigroup's analysts said about Intel, and I will be quiet. Of course, there's an ad. Of course, there's an ad. Just bear with us for a moment here, friends. It'll be worth it, I promise. Oh.
Company?
Yeah, great question. So obviously there's a lot of political pressure going on with various parts of the market right now. I think that has to be somewhat of a factor. But as far as Nvidia goes, it's no skin off their back. So they gave Intel $5 billion. They're down to their last $67 billion in cash. I don't think that's a big deal. They already have some products called Grace that offer an ARM core. So now they're offering an Intel core with that. And then they're going to, sort of loan their graphics capabilities out to Intel to let Intel integrate the graphics in their own laptop chip. So for us, the 5 billion is no big deal. Intel is still behind AMD in terms of processors. And if you have a better graphics chip, it doesn't necessarily help the actual core processor. And then on the sort of AI product offering, that might end up being 500 million, a billion, maybe 2 billion at best to Intel, but that's years out. And Intel's a $53 billion company. So again, not enough to move the needle. And more importantly, we think this continues to keep Intel in this perpetually money-losing foundry business, which we think they should get out of. And if they did get out of that, i.e. making chips for other companies, we think that unlocks $1 to $2 in earnings power, and we're loving that. But this sounds like this is just going to keep them in this like perpetual cycle of trying to make chips for other companies.
So you don't think that Intel could possibly give up the foundry business at this point because of this partnership with Nvidia? Does that preclude them from that, or could that still be a path down the road? And is that the only way you'll get back to a neutral, at the very least, on Intel?
Yeah, great question. Well, obviously, if the stock goes down, I go back to neutral.
Right.
That's number one. Number two is I want to make two important sort of clarifications there. So Intel does foundry for their own processors, and we definitely think they should stick in that. They've managed to make a lot of progress there over the last 2 to 3 years, but it's this making chips for other companies, especially for leading edge. They've been trying to do this for 10, 20 years. They are no closer now than they were 5 years ago, 10 years ago, 15 years ago. They're still 2 to 3 years behind Taiwan Semi. They're losing billions of dollars in this. Yes, it's possible that they could do it, and we've outlined that. I mean, first of all, you probably want to hire like 2 to 3 Michael Jordans from Taiwan Semi to come and teach you how to do the foundry business. Intel has not done that. They have like a non-foundry person running the business, and the foundry business is almost antithetical to what made Intel great, right? Like what made Intel great was manufacturing their own chips. It's a single processor for Intel. It's not taking somebody else's recipe and making it yourself. So you just have to completely turn the company around. And we just think that's not their forte. So if this, keeps them in the business, and based on the feedback that I received, if you heard the conference call with Intel and Nvidia yesterday, like a third of the investor questions were on, is this going to be a foundry deal? Are you going to get a foundry deal? I mean, I hear it every day. I just think that they're still, kind of running down that rat hole.
A rat hole.
Matter where
They're running down the rat hole. So disaster. Okay. Intel is dumpster fire. You could pick whatever you want to say, but I would not bother. Like, everybody's keeping it on life support. That's the problem with Intel. All of this money that's being thrown is like keeping it going. It's like it just needs to like sell this foundry business. That is the real thing. Just not a big fan at all. Okay. Josefa, BMNR. Yeah, Bitmine. Yeah, this one's another one that's come up. It has one analyst covering it. Yeah, so I got into some Bitcoin miners during COVID because I was just bored. I'll come up with the names. They're trading for like nothing. Argo Blockchain PLC, Big Digital Assets Inc. So again, I'm not. People have mentioned Bitmine, but anything that's like Bitcoin mining is very energy intensive, and it's kind of like if you were drilling for oil. You have to have a certain cost structure, and the only time it makes sense to drill is if oil's above a certain price. So like, for example, most of the time with like shale, you have to have oil prices above $65 per barrel for it to be profitable. In the case of Bitcoin, I don't know what those breakpoints are for companies, but that's the real challenge. That one came on the radar. People were talking about it, asking me questions about it. But whenever I come across something like that, it's basically like oil, but with Bitcoin. It's like the same issue with it. Oh boy. I don't often invest outside the US, but India seems very tempting. Their GDP is outpacing majority of economies, and I don't see it slowing down with AI, especially as they continue to develop their infrastructure. So I wish, and they might come on later. So some of my MBA students from Rutgers happen to be Indian, and like they have like the inside scoop, boots on the ground. And if they join, it would probably be like towards the latter end. They would definitely give you the proper perspective. What I would say is if you were going to invest, do it via an ETF. That would be the approach. Actually, I do know somebody who's here that is Indian, so they might be able to opine. But it's a very high growth, right? BRICS, right? Brazil, Russia, India, and China. Russia is not even possible to invest in. Not that you'd want to. Brazil's going through its own issues, so that leaves you with India and China. I would say of the four, India is the most appealing of the four, for me personally. So I would advise if you're going to do it, don't invest in like an individual stock. I would go for an ETF. But yeah, sure. I mean, if you have a macro view on something, there's nothing wrong with that. But I would say like focus on the longer term, and really try to like map it out and say, okay, like what do I extrapolate out like 10 years from now? And where do I see the country being 10 years from now? But you also have to look on like the world stage, like think of investment that's going towards India. Um, what does that look like? Businesses that are starting in India, what does that look like? So you always want to be kind of where the innovation is happening. So obviously from that perspective, I'm a big fan of the US. But yeah, I don't see anything wrong with that. Me personally, the only time I've invested outside of the US has been in like international companies that have like an ADR in the US, or kind of like you're referring to, I would look at ETFs. Vanguard has to have an ETF for India. What is the best electrical energy stock? That's a good question. We actually have a sub on the channel who like literally works in that area and is like a whiz. He's actually an electrical engineer. He would be better able to tell you. But what I would say is like, if you think about electrical energy, i.e., utilities, very heavily regulated industry, so not typically a big fan. That being said, though, there is an obvious growth opportunity as it pertains to AI infrastructure, i.e., data centers. That's going to require a ton of energy. The real question with that is how are they going to be able to generate all of that energy and that power? The most efficient way would be nuclear. I know that's like pretty controversial. I don't see why, but that's going to be the most efficient way to do it. Eric. Hi, Ken. Have you seen a company called Prosus? Curious to hear your thoughts on it. Trades at a 46% discount to NAV and owns 20% of Tencent. Okay, interesting. Along with other companies in emerging markets. Would love to hear your thoughts. Let me pull it up. Okay. Anderson, thank you. Hold on. I'll go right back to that in a second. Anderson said Bitmine is an Ethereum treasury in addition to Bitcoin mining. Okay. That's really the play. Is treasury. Yeah, so basically stablecoin treasury. There's a few companies that are getting into that. That's an interesting play with Bitmine. The Bitcoin mining is not really interesting to me. The stablecoin for treasury is very interesting. So let's go back to Eric's question. Prosus. I personally am not familiar with Prosus. 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 Okay, this looks like it's non-US based, so this is going to have potential issues in terms of getting into the stock. So let me go ahead and share. So it looks like you have to invest in the Netherlands. It doesn't look like this is an ADR, but let me see. Prosus. It trades over the counter, yeah. So there is an ADR. It's done pretty well recently. Long story short, I'm not familiar with it. But it sounds like from what you're saying, they have investments in Tencent and a few other companies, which is pretty interesting. Engages in the e-commerce and internet businesses in Asia, Europe, Latin America, North America. Internationally operates internet platforms, classified payments, fintech, food delivery. Tencent and other platforms. Used to be known as Myriad. Changed name to Prosus. That one's interesting, especially when you say it's at a significant discount to NAV. 16 analysts cover it. Okay, that's interesting. But like, what is the close? The close is 61. It looks like even though it says outperform, it's not trading at a discount based on the recent close. I had like 61 as the recent close. This is PR. So you just gotta like watch out when you have these ADRs. There's a lot of like weirdness that happens. So sometimes the price that gets quoted, like your value per ADR is like 1/5 of that. So it's just like it's one of these things where it's like, is it worth all of the headache and complexity? But unless you can get into it via an ADR, which is an American depository receipt, you're going to have major tax implications. That would be my bigger concern. So if you're going to do something like that, I would just make sure that you do it in an account that has tax benefit. So I wouldn't do it in a brokerage. I would do it in like an IRA if you were going to invest in it. That's why I would just be a little careful. Okay. Okay, so this goes back to the Bitmine one analyst. I'm looking at it because if like MicroStrategy, it could be very valuable. It's an e-treasury. Tom Lee's the CEO. Yeah, the Tom Lee connection. Yeah, I mean, if they're holding like so MicroStrategy, the reason why it's going up isn't because of their operating business, it's because they're holding so much Bitcoin. So if they're actually going to be like a custodian for the treasury Ethereum, that would be interesting. But that's also it's like an evolving area. So that's the other thing to be cognizant of. It's definitely an evolving area. What do you think about the SPMO ETF? Sorry, I forgot to put this on screen. SPMO ETF. Spamo. So I have eaten spam before. I like it with eggs. But Spamo is S&P 500 Momentum ETF. So this is going to be something that will definitely perform well and outperform the S&P when the market is trending up and to the right, which fortunately it has. But this is also the type of thing that when the market goes the other way, it's almost like a levered ETF kind of thing. It will also go that way and get slammed. So it's interesting if you look at the performance of the S&P 500 last year. If you remove the Mag 7, it would be down like 2%. So when you think about that, it's like, what's driving the value is obviously the Mag 7. So then that would beg the question, like, why don't you just invest in the Mag 7? It's like, I don't know, why not? So anytime you have these ETFs, it's an interesting concept. What I would want to understand is what is their investment criteria. So I'll just look it up real time since we're all hanging out anyways. Like what do they qualify as momentum? Like, is it a price change over a period of time? SPMO ETF investment thesis. Because they're going to have capture the momentum. Investing in the 100 stocks within the S&P 500 with the best recent performance. Okay. Highest momentum scores. Okay, so like a pharma French factor model focusing on momentum. I do have to say it's surprisingly low. I was going to say it's probably got a high expense ratio, but 0.13% is not not actually that high for a thematic ETF. And it also says it has a lower tech concentration. So it should have less volatility as a result. So what you want to do whenever you're considering any ETF, you want to look at a Sharpe ratio. So the Sharpe ratio is the expected return minus the risk-free rate over the standard deviation. So for example, if I told you I made 100% return, but I also took on, 200% volatility, then the Sharpe ratio in that case would be half, right? It wouldn't actually be that good. You want to find Sharpe ratio greater than 1. That's the key. So if you can find something that has a Sharpe ratio greater than 1, you have a high risk adjusted return. That's what you're looking for. So what I would say is look at the Sharpe ratio for SPMO, and if it's above 1, rock and roll, man. Is it true that high net worth individuals are overweight market neutral hedge funds, so they will have money to buy the dip? If so, they will be able to get liquidity and do so, given that hedge funds are illiquid. So high net worth investors, they're also going to have literally their own credit facilities that are going to be lent to them from the bank where they have their assets. So they're able to take advantage, like they're able to get loans. So like, for example, Elon Musk, Jeff Bezos, all of these guys that are multi-billionaires, they're able to borrow against their stock. So what happens is a lot of these large financial institutions that have these high net worth investors, they're going to actually offer them a credit line so that they could personally pull money and make investments from the bank by pulling on that credit line, which is kind of crazy. So stepping back, yeah, they're able to take advantage of opportunities that we're not normally able to. So I wouldn't necessarily say they're overweight market neutral hedge funds. So market neutral is like a beta of 0. It's called an equity long short. So they try to neutralize beta so that the only thing that's reflected at the end of the day are their like ideas. So they basically want their idiosyncratic risk to be reflected in their returns. But usually what happens is they're going to have credit lines available to them, even though they're fully invested. But what I could say to you, having advised very large financial institutions, banks, I mentioned it at the beginning of the YouTube videos, they're very typically going to be more heavily weighted towards just like the market equities. Their typical strategy is going to be a core satellite strategy where they're going to be like 80 to 90% core and then like 10 to 20% satellite. But they're actually going to have the ability to buy the dip just for the simple fact that they can borrow against their asset base, whereas like the average mortal like us cannot. But yeah, the market neutral aspect of it is not really as important as the ability to get into and out of said fund. So like if you own an interest in a hedge fund directly, it's going to be way more difficult to divest of it than if you're already at a large financial institution like a JP Morgan, for example. Like if you needed to exit, like they'd find someone, you'd take a haircut on it, but they'd find someone to invest. All right, here we go. Going back to the Indian ETF. As an Indian, I said the only exposure you want is an ETF. You do not want to pick individual stocks unless you understand the regulatory system. It's a whole minefield picking companies. There you go, Garamay. You got your answer. All right, so okay, so this is actually a good question. Let me pop it up on the screen. So Tylenol is owned by Kenvue, no relation to me. Down 8% today, down 20% this month. Seems to be trading down on news today, but curious how much revenues can be affected from the news. So the stock price can be significantly affected by the news. Intel. The company is still a dumpster fire. It's still operating very unprofitably, but they have the Nvidia announcement last week. Stock goes up. that doesn't actually like change the fact that the business is unprofitable. So now, when you have negative news, in order for it to hit revenues, it's going to take time. Remember that the stock market is a leading indicator. So the stock price will change. It will start going down before the actual results are bad, and it will start going up before the good results actually come forth. So just be mindful of that. So like, for example, when we talk about like Lululemon, you know, you can't wait until they report like earnings that are solid and, you know, everybody's buying yoga pants again and they figured out the tariffs. Like, it's too late at that point. So that's why, like, on the video, I said, you know, wait for it to bottom out. Now, wait for it to bottom out. Like, that means you're going to be buying it after it's already coming up. So the news can have an impact on revenues as like a flow through. In this case, the example given is Tylenol. So I guess the question you'd have to ask is, are people less likely to take Tylenol today or tomorrow or a week from now based on the news that was delivered? And I didn't hear the exact news, but I heard that there was some sort of connection perhaps with Tylenol, mothers taking Tylenol, and the impact on babies and autism. So you'd have to say to yourself, who are the largest users of Tylenol? And are they going to stop using Tylenol? Are doctors going to stop recommending Tylenol? So like, what is going to be the impact? That is much harder to measure. Like, my mom has arthritis and she takes Tylenol extra strength. You would literally have to handcuff her and refuse her ability to take it. Like, she swears by it. She's like, it works. She's going to keep buying it. I think like maybe the casual person that's like, I have a headache, maybe they're going to be less likely as a result. So it's going to take time for it to actually impact the revenues. But I would say I wouldn't dive into something. That's where you get value traps. I wouldn't dive into something when you like hear really bad news. That's usually not the time to just like dive in head first. What do you think about Hess midstream? So I have not looked at that one in particular, but like, let's think about it, right? There's you're drilling oil out of the ground, right? Then there's the processing component, and then it's, you know, all the components that come out of it, and then it gets sold. So midstream is kind of more so like the processing piece. You know, really anything that's exposed to oil is going to be contingent on oil prices. So if you thought, for example, that oil prices are low and they're going to increase substantially for whatever reason, then yes, you would want to own like oil drillers, you'd want to own midstream, you'd want to own like, you know, the entire gamut of it. We were actually talking about this ironically earlier when we were talking about Bitmine and like mining anything out of the ground. It's a function of what that cost is with the thing that's in the ground. So it's very important that when you look at what is in the ground, like, there's going to be a cost to extract it from the ground, whether it's, you know, gold, it's oil, whatever it is. So there is a cost that you have to be above in order to do it profitably. So I mentioned earlier, like, oil is usually around like 60, 65 a barrel is like below that. Like, they just shut down the operations. They stopped drilling because it just doesn't make economic sense. They're losing money on everything that they drill. But if it's higher, then they will make money. So I am not familiar with Hess Midstream. I'll just pull it up for you on Cap IQ so that we could take a quick look. Looks like 6 analysts follow it. Wait for it. Here comes the big share. 6 analysts follow it. It closed at 35, median 44.50. So you have a decent discount. That'd be a 20% discount, but the general consensus is hold. So again, that's usually going to be a play on oil, but be careful. LP, all right, limited partnership. If you own that outside of an IRA, major tax implications. Major tax implications. So like you have to be very careful with that. You could get like absolutely eviscerated. It's the same thing with REITs. It's the same thing with BDCs, business development companies. Because of how they're structured, if you own them in like a brokerage account and you don't own them in an IRA, you will regret it. So be very, very careful. I would not own that outside of an IRA. Okay. This is interesting. Sharp ratio last year, 1.62. That's impressive. Yeah, so that's the S&P momentum. So rock and roll. That sounds interesting. Someone else had mentioned to me that one previously. Do you know CFA Investment Foundation's certificate? I do not. It's fascinating to me, like how many like certificates are out there. I'm going to look it up real time because I have not heard of this. CFA Investment Foundation's certificate. And I just want to see what's involved. So something came up for Harvard, Cornell. All right, here we go. CFA Institute. Let's share the screen so we're all looking at it together, friends. Okay. Here we go. All right, so this certificate, 350 bones. Okay. Tangible knowledge of the investment industry. Being able to solve and communicate solutions for complex investment issues. Covering the fundamentals of the same topic areas is level 1. Gain essential understanding, subject matter expertise. They're going to have a video. It's the greatest thing since sliced bread. And again, I'm a CFA charter holder. So enhanced knowledge, competitive edge, further learning, specialized vocabulary, building confidence, enhanced professional profile. Who should enroll? Students, professionals outside of the investment industry, professionals already working in support roles within the investment industry. So what I would say, just giving it a very like tertiary look here, if you're like serious about investing and you are in the investing industry or you want to pursue investing as a career, I would just pursue the CFA and get the charter, take level 1 and just like go through the paces. On the flip side though, I would say if you're not planning on working in finance and you're just like, you know, an everyday investor and you want to get smart and learn the lingo and get a better grasp of things, that's who it sounds like it's for. So it really is a function of what your ultimate goal is, but I'm not familiar with it, but it does sound interesting. Oh boy. What do you think the best way to create wealth other than investing in stocks? So, if you have some sort of specialized knowledge and you can share it with the world, I think that is a way that you can absolutely create wealth, abundance, and opportunity. Okay. So, I think the fruits of that labor, you want to invest in stocks. Stocks and stock investing is very passive. Okay. Now, stepping back, entrepreneurship is definitely going to be the way to wealth. The people that are the wealthiest, you know, all you have to do is look: Warren Buffett, Jeff Bezos, Elon Musk, Bill Gates, like all entrepreneurs. So in terms of the most wealth, that would be the way to go. The most certain wealth, stocks would be definitely the way to go. So I would say creating wealth, having some sort of specialized knowledge that, you know, technology cannot take away, and being able to express that and articulate that in a simple fashion, whatever that is. I mean, there are people, there's like this chick, Miss Excel, and all she does is like Excel shortcuts. Dude, I could do Excel shortcuts like standing on my head. I just like don't have the patience to just do that all the time, like not interested. It's like, that's a tool for me to do the models and financial analysis, but I have zero desire to like just focus on teaching that. But again, that's specialized knowledge, and that's something that is very lucrative. So if you could figure out something that's specialized knowledge that you could ultimately sell, that would be the way to go. Something that you could make unique to you, the way you do it. You have some sort of like specialized system. That would be the key. But yeah, entrepreneurship. That's the answer for the most wealth creation. But it's also the most risk, and most people are not willing to do it. Hello, how are you, Michelle? Okay, about 6 months. Oh, I'm still learning the whole platform here, so I have to show it on the screen before I read it. So, lo siento, friends. Okay, about 6 months ago, I also had the strong desire to buy into India. Unfortunately, the more I learn about the regulatory environment, just like Pratyush said, and the short-term tariff space, I'm less inclined. Okay, so Garame's getting his answer real time. I'm a big fan of midstream right now, but NG looks so much better than oil to me, natural gas. Also, buy it in a Roth. Yep, it's almost guaranteed to be a limited partnership, so no capital gains tax, just ordinary. Yes. All right, so good. Great minds think alike. All right, excellent question. Lasagna. That name makes me hungry. I could definitely go for some lasagna right now. How do you think declining interest rate environment will affect equity markets? Okay. So let's understand monetary policy, economics, and like really kind of like think through this, right? So high level, there's monetary policy, which is what the Treasury does, and there's fiscal policy, which is the U.S. government. So you could just think of governments in general. So fiscal policy is like taxation, how the government makes money, right? And then the market is impacted by the Treasury. So, i.e., like changing of rates, monetary policy, all of those things. So the three ways that is done. Number one, changing the reserve requirement. So for a bank, if they're required to maintain higher reserves, that means there's less money in the system. It's basically the equivalent of having higher interest rates. If you have lower reserve requirements, then that's the equivalent of having low interest rates. So that is something that's very rarely done. In the United States, if you actually look, it's like zero. There's no reserve requirement, which is madness. But if you look at other countries, it's like 20, 30, 40%. Then the next way is changing the Fed funds rate, i.e. interest rates. That is something that takes time. That is something that happens infrequently. So that is kind of the base rate, and everything's priced off of that. Now, the other way, and there's a reason why I'm going through this, the other way is open market operations. So that's the buying and selling of government securities in the market. So if the government buys treasuries, so the government's buying treasuries from banks, what's going to happen? The government's going to give money to the banks, which is going to add money to the system. That's the equivalent of lowering interest rates. Now, if the other thing happens, if they sell treasuries out into the market, they're pulling money from banks and putting it into the government. So that means there's less money in the system, which is the equivalent of raising rates. So net, lower rates are going to encourage growth. They're going to encourage borrowing and investing because it's cost effective. And the way you want to think about this is always think about it in extremes. And I know you're like, what, extremes? Yes, extremes. Don't think of what's the difference between 4.5% and 4.25%. I'll tell you the answer. Not much. You want to think of what's the difference between 10% and 1%. So if I told you, hey, you can borrow money at 1%, you're going to be like, you know what? I'll just borrow money even if I don't need it because it's so freaking cheap. Like 1%, it's a joke. But there comes a point, like if the borrowing rate is 10%, the only way that you're going to borrow is if you can invest that money in something that's more than 10%. And there's not going to be that many things where you're going to like, I know this is going to be worth more than 10%. There's a lot of things that are going to be worth more than 1%. So net, once rates get to a certain level, all right, people are going to say, you know what? I can't generate 20% returns in the stock market. I'm just going to put it in the bank. And I'm going to get, 10, 15, 20%, whatever the high rate is. But when rates go down, it's like, why would I keep my money in the bank? I'm losing out. Like inflation is going to eat away at my purchasing power. I'm actually incentivized to invest in the stock market. So lower rates, if they continue to go lower, that should encourage borrowing, investment. The big thing that really needs to happen in the United States specifically is the real estate market is just at like a standstill. So rates are going to have to be low enough to encourage developers to actually build properties. And again, you have to think of cost benefit, right? So they have to make enough of a return on the back end to justify the cost of funding on the front end. So that is really the issue. So do I think a 25 basis point cut has a major positive impact on the market? No. It's going to have to go down continually in order to have a net positive impact. But again, you have to look at employment. That's going to be another big factor. But net lower rates are going to be better for equity markets. So I know that was like a little bit of a circuitous answer, but I had to give kind of the full palette there. So Ajit said, with the market factoring in 2 interest rate cuts being in the year while the Fed balance sheet is contracting, what are your opinions on this? Well, if we think about it, the U.S. government has way too much debt. All right. So that's obvious. So one of the ways that we can mitigate that is with lower rates. So remember, the interest cost on the $37 trillion of debt, it's 30 something trillion of debt, is costing the United States government trillions of dollars for its budget. So if you lower rates, you lower the cost of financing. That's the thing that's ironic. Like when we raise rates, we're actually making it like more prohibitive. I mean, it's like crazy. If like you were a bank and you're charging yourself, that's really what's going on here. So net lower rates are going to free up capital to be able to pay down the debt so that if and when rates need to be raised, it's not going to like choke off the growth. So 2 rate cuts would be good, but I think it's just merely like a step in the right direction. I'm more concerned about growth than I am about inflation personally. Tariffs are bringing in revenue, which is good. But I think people are so transfixed on inflation. And the reason why is because it happened so quickly because of the stimulus. But that's not reality. And it took time to actually flow into the system. So I'm positive on that. I think it's going to reduce the debt on the balance sheet. And that's something that is absolutely critical. Like we can't kick the can down the road anymore. It's like an issue right now. But tariffs are something that was not contemplated as a source of income previously. So that's going to be a tremendous positive for the government, its balance sheet, and also its income statement. Oh, thanks. Always like a word of encouragement there. I'm doing great. That's awesome. So it's funny because like I'm like looking at the comments as I go down. Do you have an opinion on Restoration Hardware? And then I'm going to just go right to Michelle here. Don't invest in Restoration Hardware. I'm from the industry. Housing is so depressed and it continues. Yeah, so Restoration Hardware, that one has been a value investor's, tantalizing tale for a while. It has asset value, but it's more of like a novelty. I think if you're like making changes to your house, I don't know, maybe if you're like high end, you're going to go to Restoration Hardware. But, Home Depot, Lowe's, probably more likely. Restoration Hardware is like more of like a novelty. I remember when I was growing up, there was a place in the mall. I don't think it exists anymore. It's called Sharper Image. And it was one of those things like I remember as a kid having like no money. You go to the mall and they had like the massage chairs. And like the massage chairs when I was a kid were like really crude. They would just like vibrate. Like today it's like pretty close to an actual massage. So you'd go in there, you would sit in the massage chair, you'd hit the vibrator thing, like, oh, this is pretty cool. And then you'd go, like, there'd be like the Newton's cradle, you pick up the one ball and it's going back and forth. You're like, oh, that's cool. And then they'd have some of like those like lava lamps with the bubbles and stuff. And you'd walk around and then you'd walk out. And it would just be like, you're going to a museum, You're not going to take anything home. That's my bigger concern with a business like that. But yeah, Restoration Hardware always ends up on like the radar of value investors because it has tremendous asset value. But that one, I believe, was in chapter 11 a few years ago. So it obviously must have exited. Again, you have to think in like this technological environment, the more retail space that you require, we've obviously seen this with a whole host of retailers, Bed Bath and Beyond being a good example. Like if you would have said 10 years ago to somebody, Bed Bath and Beyond's going out of business, they'd be like, no frickin' way. Bed Bath and Beyond's going to last forever. And then it's like, rip, Bed Bath and Beyond, dead. You know, that's the thing. The real estate part is the part that concerns me. That's the part that concerns me. So we have back and forth. I like the fact that we have someone that's in the industry. So high-end customer greater than 250,000 in income, and then our friend who's actually working in the industry, not really. So okay, here we go. Sharing this real time, folks, real time. Did it show up? Hold on, the stupid show on screen thing. There it is. So Michelle said, RH serves high middle class. I don't know why it's not showing up on the screen, but high middle class. So yeah, I think like upper class. I mean, I'm trying to think to myself like customization. That's really kind of like what you're going for, more of that like novelty piece. So that one, it always shows up as like an asset value, but you have to look at the actual like cash flows generated. And in the past, when I've looked at it, I mean, like, look, I'll just pull it up on Cap IQ. We got it open. Let's go nuts. But my guess is it's going to show up as like a real asset value. All right, here we go. Wait for it. Prepare to be amazed. All right, here it is. RH. All right, so recent close 218, the median 235. So not like a huge discount, and the general consensus is hold. My guess is that this would not be like very high growth. I would assume this is the type of company that's buying back a ton of shares to reduce the share count, and that's how they're like generating value. But if you look at the leftmost column, 2025, all those red arrows, basically everything is below expectations, and even on a quarterly basis there. So that's kind of, it's again doing like a very like cursory look at it. It looks to me to be kind of like a classic value trap type scenario. Yeah. Okay, here we go. So couch there is 10,000. 4% of pre-tax income is a lot for a couch. Yeah, I think it's more like 500,000 plus. And then also another valid point, middle class is crushed right now. Like you think of the cost of housing, like not the stuff that's in the house, but like if you're renting, I mean, like so freaking unaffordable, it's ridiculous. So, you know, you're talking about someone that probably owns their house rather than rents. I would say that's probably a big part of it. But you always have to think of like the end consumer and like how much, like who these people are that are doing this stuff. Like I was reading in the Wall Street Journal, I think I might have mentioned it the last live stream or maybe the one before. The most expensive house in the United States of America is for sale. We should all like throw money together and buy it. Not happening. But so it was like, I think it was in Idaho. I mean, it was like 300 acres, like ridiculous. Actually, no, it was more than that. It was like 1,800 acres, just like absolutely ridiculous. Like they had everything custom. Like they had an oxygen machine in the house so that you'd wake up refreshed. Like, oh, okay. You know, they would be perfect. I bet they buy all their stuff from Restoration Hardware. But again, like you'd be way better off being like a Home Depot or a Lowe's and having the volume aspect than a Restoration Hardware, which is selling, you know, like more of a one-off. Uh-oh. Danny's entered the chat. It's pretty sad you guys are judging Restoration Hardware's growth and value. But meanwhile, meme stocks have 1,000 price to sale without rev and grow 50% per day. It's very hard to be a value investor right now. Danny, I feel your pain. It is very hard to be a value investor right now. It's definitely not our time to shine. And it's funny, like some of the comments on the channel, people have said, you know what? I kind of, I miss market downturns. It's like, yeah, because now it's like you just throw spaghetti at the wall and it sticks on everything. And it's pretty crazy. Like we've seen it with like SoFi has ripped like beyond its intrinsic value. Obviously, Palantir, we don't even have to have that discussion. And the problem is you're like feeding the gremlins because the people that like, I came out with my hymns video. I'm like, overvalued, not interested, don't buy it. And then like it still went up and it's like, you're an idiot, you're a moron. Ah. But it's like for anybody that understands fundamental analysis and valuation, when you actually think through that, it's like, okay, is this really undervalued? No, it's not. That would be a momentum play, but I don't think that's what SPMO is investing in. All right, so we're back on Restoration Hardware. High-end customer does not buy there. Ha! I like this one, Cooper. It's been hard to be a value investor for 18 years. Accurate. Yeah, really, like since the financial crisis, after that, quantitative easing just like ballooned everything. Just pretty ridiculous. I just want to make sure I didn't miss anything. So Constellation Energy, Nextera Energy, and GE Vernova. So I know that there's somebody that's literally in the chat right now that would do an excellent job comparing the three. So I'm not just going to like share them. I'll let them opine. But again, energy companies, remember, like utilities are very heavily regulated. That's not going to be a high growth business. That's usually the land of like dividend investing. Builders are changing their strategy. They're focusing a lot more on renting. And with the cost of housing going up, they will boom with more developments and with this new strategy. Yeah, that's true. Innovation Homes is one, and I've owned it in the past. I mean, like asset managers are like literally just buying up houses and then renting them out to people. What are your opinions on developers? Look, we need housing supply. That goes without saying. So I'm positive, but right now it's still not cheap enough from a borrowing perspective because their costs have to be made up on the back end. And when you think of like the materials, the supplies, the labor costs, and they're borrowing for all of this levered money, the real borrowing cost has to go down. That is really the crux of it. So I would be more interested in like the plans from the developers. There was actually, it's so ironic. There was an article that appeared in the stock app that was talking about developers, and it said rates have come down, but developers still aren't developing. What's going on? Or maybe that was on the Yahoo that I was looking at earlier. Hopefully the news article is still there because it would make an excellent salient point here. News. Alphabet, nope. Berkshire, nope. BYD. Just regular crappy Yahoo Finance. What pops up here? Okay, here we go. I think I'm going to find it now. I'm feeling positive. Supreme Court, Apple, Axo, Better Home. Dealing with insurers is stressful. That is true. Revlon. Damn it. I had this here before. I don't know where the hell it went. Bollocks. Yeah, basically there was an article I was talking about. It might have been in the Wall Street Journal. It was talking about real estate developers, even though rates have come down, they're not developing as of yet. So that is something that I think is very telling, because remember, if you're a real estate developer, you have to plan things out. That's something that you have to really factor in. All right, so I like this. There's like back and forth in the chat. Yeah, Cooper, David asked about those companies. Yeah, that's why I said that's Cooper's wheelhouse. I'll just let him riff on that for you. Ooh, okay, hang on. Could you share your thoughts on Fiserv? I haven't looked at Fiserv in a while. It is a very interesting company. I've owned it in the past. When I was at the hedge fund, we owned it, and we were big fans. This is interesting. Wow. So it has a 130 valuation. The median is 184. So that's 50. So yeah, wow. That's like a 30% discount. 1.52 outperform. Very nice. So they had gone private and then reemerged. And I know they're doing a lot more in the fintech space. I'm trying to get a sense of their growth path. Okay, not bad. I haven't looked at it in a few years, but it is one that's definitely pretty interesting. Let's see this trends tab. See if there's anything interesting here. So this is basically showing if these estimates are going up or down. So the 2025 quarter is okay, so it's kind of all over the place. Womp womp. So the estimates were going up 12 months ago, 9 months ago, 6 months ago. I'm looking at the full year 2025, and they've been going down recently. So that is the trend in the estimates. So I think that probably has a negative impact on things. And then revisions. Okay, 33 analysts, 2 upward, 3 downward. So that's not that much. Last 2 months, last 3 months. Okay, last 3 months, 16 downward revisions, 11 upward revisions. That's interesting on EPS. Let's see revenue. Okay, so this is where you want to focus your attention, like down here. So for full year 2025, 15 downward revisions. 15 downward revisions in the last 3 months. So that's why the stock is definitely pulling back. So that's why, like, none of this happens in a vacuum. So that's why I always get a kick out of it. Like on the is this being shared? Hold on. I thought I was sharing the screen. Yeah. So if you look at the revisions for Fiserv right here, 15 downward revisions for the fiscal year, full year 2025 estimates in the last 3 months. So it seems like the trend is downward for the analyst revisions. So none of this happens in like a vacuum, and I think that's the issue. Like some like wingnut commented on the channel like, "Oh, Wall Street," and they were like all like negative, anti, whatever. It's like, dude, like you're gonna analyze a stock without the people that are literally driving the value of the stock, the people that are being listened to by hedge fund managers and portfolio managers. It's like, okay, you could do that. Good luck. Have fun with that. But I'd have to take a deeper look at Fiserv. Yeah. Yeah, Rutgers didn't cover the spread. 5.5 at Minnesota. I feel better about Minnesota than I did about Iowa. Iowa's like a scrappy team. You know, I saw them against Iowa State. Look, Rutgers had to win that Iowa game. They didn't. Minnesota, I'm positive. I'm bullish on that game for Rutgers. But man, it's going to be tough sledding. It's tough. I mean, I think we play Ohio State. I know we play Ohio State. The homecoming game is Oregon. I mean, some really evil person must have put homecoming on the schedule for that, because that's not going to be good. But we have Washington. That's winnable. Purdue, I saw Notre Dame beat the hell out of them. That's definitely winnable. Maryland is a wild card. Nobody thought that they were good. They're freaking undefeated. And then it's like Ohio State and Penn State are just going to absolutely eviscerate. So Illinois seems to be a fraud. I don't think they're like legit. Everybody thought, oh, top 10, and they got their ass handed to them. So I feel better about Minnesota. Definitely feel better about Minnesota for sure. Hello, Cyan. All right, let's go up. I apologize. I got preoccupied with Fiserv there. Will HHH Howard Hughes Holdings benefit from Fed cuts? I mean, right now they're like a real estate developer, and it's kind of like masquerading as a real estate developer that's becoming like a holdco for Bill Ackman. I mean, look, every company should benefit from Fed cuts because that reduces the funding cost. And if you reduce the funding cost, it's just you have a lower cost of capital. If you have a lower cost of capital, your valuation is going to go up. So if you kind of like extend and connect the dots there, that's really the key. So yeah, I think they will benefit just like everybody will benefit from that. All right. So anything else? I'm going to get close to wrapping in a little bit, unless we get some more interesting topics and whatnot. While I'm at it, while I'm waiting for more commentary, I always talk about the school community, and I don't really showcase it, but I want to take a moment to do that so you guys could see what it's like. So for those of you who are not in school, many of you are in the school community, but it was interesting. Someone explained it to me the other day, and I was like, oh my gosh, that makes so much sense. Like on the YouTube channel, you learn what to buy, but you never learn when to sell. And that's a really important part of this. So I share my portfolio. Ooh. But if you go to the classroom, I have these deep dives. So in addition, you can actually get the financial models. All right. So the actual financial models in Excel that I produce for the YouTube videos. Now, full disclosure, before you like hop in and you're like, oh my gosh, I'm going to download all these models. These are for sale. So just to give you some perspective, when I get hired by like a hedge fund to do a valuation, it's literally $10,000. So like that's what they pay for a valuation. I know that sounds absurd that like I'm literally doing this on YouTube for nothing, but to buy the financial model, it's 1% of that cost, which is a joke. And it's fully functioning. It's not just like values. But this is really the interesting area. So if you go here, you will see the deep dive. So I cover SoundHound. I take 35 minutes covering SoundHound, walking through my model and going into things that I just literally can't cover on the YouTube video. Also, you get access to a PDF of the full model. So if you remember back on the channel a while ago, I ended up having like really deep dives where I went through the full model. I showed the data tables, the bear case, the bull case, and all of that stuff. But the only way to access that is here with the actual PDF of the model. And then you have a huge community of like-minded people who are posting in here. You get updates of when I'm going to post. And it's just a pretty cool thing to check out. So if you're interested, feel free. I got the whole about area right here. So you could go here. 45 members. We're at 50 per month. Once we hit above 50 members, I'm going to raise it to 100. So that's that. I just figured I'd profile that because I mentioned it on the channel and then never really go through it. TTD. All right, hold on. I'm missing. All right, so first off, let me share it on the screen. Can you please share your thoughts on TTD and make a video for it? So, TTD, the trade desk. I looked at the trade desk a while ago. It's been a while. They do seem to be quite undervalued. And they do have an outperform rating. From what I recall, their business model, let's see if it's changed. Okay, it's self-service cloud-based ad buying platform. Allows buyers to plan, manage, optimize, and measure data-driven digital advertising campaigns across various formats and channels, United States and internationally. This is something I'd have to go back to. I looked at it some time ago, and it was interesting. It definitely appears to be trading at a discount, but honestly, I'd have to dig into that. I have to also look. So this is like pathetic, but even though we got 10,000 subs, thanks to all of you, I still have to make my videos based on what people are searching for, rather than like HHH and Sterling and all of these other ones. So let me see what TTD comes out at as a search. Okay, it comes out 68 out of 100. So you guys are giving me the ideas. I like that. I bet Grab is another good one. Okay, TTD. All right, so this is now like a hot stock on YouTube apparently. I'm actually curious about Grab because that's been mentioned a few times. Yeah, decent. TTD is like up there with Nvidia in terms of the search juice. So I'm gonna add that to the list. I'm gonna have to take a look at TTD, and that might be coming to a YouTube near you. Yeah, if you guys like figure out something where it's like, hey man, this is worth looking at, and people are actually searching, that is definitely something I'd be interesting. Ooh, have you ever shorted a BDC? I have not shorted a BDC. I've only gone long BDCs. The only logical reason I would short a BDC is if they held toxic assets. I bet it was a good strategy during the financial crisis, but I've never actually contemplated shorting one outside of a scenario like that. Last one. Can you share your thoughts on owning physical gold versus investing in a gold index or related companies? So what I tend to find is like the gold indexes don't actually mirror the actual price of gold as closely as literal actual gold. Like, you know, a bar of gold, what its price is. Now, a lot of gold companies out there, they will actually like hold on to the gold for you. That's something that, you know, I'd be okay with. You know, you think to yourself, like, you know, you start BSing. I'm not like joking here. Like, you're BSing with someone like, oh, you own gold. It's like, yeah, I own gold. It's like, how much gold do you have? And you say some like ridiculous number and you're like out in public. Like, someone might kind of like go to your house and rob you, as ridiculous as that sounds, man. But I I would probably go that route, the physical gold route, rather than like indirect. And the reason being is like that is the actual value of gold, is the physical gold. You know, indices, and it's kind of like the Grayscale Bitcoin Trust, right? The Grayscale Bitcoin Trust doesn't mimic the actual change in the price of Bitcoin. So I would say it's somewhat similar with gold as well. But again, I think it's all a function of how much you want in your portfolio and how much you want to be exposed to. Remember, gold is primarily an inflation hedge. Also, if you were to say to yourself, gold, I'm investing in gold because I think that, you know, fiat currency going away, you know, US government's not going to be around much longer. Like, if that's the logic, like, that's really the gold argument. But that is my take. I'd rather have the physical than the index. Whoa, I did not see this. Did you see Abe saying he was willing to heavily support Argentina? What? Oh, Scott Besson saying that. No, I did not. I did not know that. You know, it's weird. The Asian countries are they're very they're like meddling into other areas of the world, but South America specifically is like a weird one. I don't understand like the connection point um, of like what they're trying to accomplish there. So that one's interesting. I have to dig into that one more. Um, all good, Jordan. You're always welcome. Okay, so Cooper says, I use Fizz, a gold holding company in Canada. Um, expense ratio 0.41. Worth it to me, but they're holding the physical gold rather than indexing to gold. That's the punchline. I would want to know like the physical gold is somewhere. Like I'm getting exposure to actual gold. So it's like I want to know that they're holding it versus like they're indexed to it. Because indexing to something is kind of like a sloppy process when it comes to commodities. Like I want to own the actual commodity. That's always going to be my 2 cents, my take on that. All good, y'all. All right, so we got another one. Bull. Love the name. Let's see it out. Oh, Webull. Yeah, okay. So this is another one here. Digital investment platform. Yeah, some of those have been like really popular on YouTube. So Bull's another one to check out. I want to see the search juice on it. I'm gonna check it real time. Bull. So TTD was actually pretty impressive. Bull, not so much. Not so much. That's the crazy thing. You're like beholden. Like once I have 100,000 subs, I'm pretty confident at that point I'd be able to just like produce videos on HHH, STRL, you know, and do that. So it will come at some point. But like now I'm still subject to having to produce the videos based on what people are searching, and then the algorithm sees that. I figured being above 10,000 would be, you know, a positive. I think it is, but we'll see. As I do more like large cap names, we'll see how that works. Have you made any new trades recently? So we were talking earlier about Constellation Brands, STZ. They report on October 6th. So I'm down on that. So that's one that I want to top off. Outside of that, haven't contemplated any trades in my portfolio. I've been fortunate that everything's been doing well. Tesla's been ripping. But no, haven't done any trades. I'm really just looking to kind of like top off a few things. I would like to get exposure to Lululemon. That's one obviously we covered a couple weeks ago. It looks like it's back on the ascent. So that's one that I think, you know, probably goes above 300 in 2026. Truthfully, I think that's one that's going to rip. And I wanted to do a video on CrowdStrike, but then that decided to just like rip over the course of a few days. I want to do a video on MasterCard, but it seems like that doesn't do well from a search perspective. But no trades recently. The only one I'm looking to do is top off Constellation Brands STZ, and then looking to I want to do an updated valuation on MasterCard. My cost basis is 340. That was a while ago. And then also Berkshire is one. It's just a real pain in the you know what to do a value of, because it's a sum of the parts valuation. So it's a real time consuming process. Oh boy. Wait a second here. Speaking of STZ, Modelo is overtaken by Michelob, I guess, as the king of beers. I did not see that. I did not see that. It's sad. That makes me want to go drink Modelo. It's funny now that I own Constellation Brands, if I'm out, like I actually will like see if I'm at like a bar or something, like I'm actually seeing if they have any Constellation Brands products. It's that crazy. And when I was driving to Rutgers the other day on Friday, no joke, a Victoria truck. Victoria beer is another one of the, it's a big Mexican beer that's in the Constellation portfolio. Drove right past me. I was like, it's a sign. Got to buy Constellation Brands. Got to top it off. Yeah, this one, that's one that I've been looking at from afar. The problem is now that it got added to the S&P, it probably ripped, which is annoying because it takes any potential discount and just eviscerates it. So I don't know, did they get added like after the market closed, or it's just recent that they got added to the S&P 500? Let's see. Yeah, it's up 8.47% over the week. I'm just going to check real quick on Cap IQ and see what they have there. Hood. Going to Hood, brah. Robin Hood. All right. So let me share this, friends. So always look at the median as kind of like the barometer here. So 120 median closed at about 125. Does not appear to be at a discount. It does have an outperform rating. Remember, like the way that they make money is on people transacting. So it's still an increasing market. That's why it was so funny to me, like when I did the video on Coinbase the last time, it's like they make money not on the price of Bitcoin, but on the transacting of it, like the trading of it. So yes, there is a correlation to Bitcoin going up and people trading more of it, but like they're limited on the actual volume of people transacting with it. So like if people are trading it, then yeah, they'll do like really well. But if they're not, then no, they won't. And if an investor or a trader thinks that they have more opportunities in the equity market to make money, then they're going to focus on that. Like traders trade, like they don't care, what it is. But doesn't look to be at a discount as of now. Yeah. All right, friends, getting close to that time. Any final thoughts here? Okay. So this is an interesting one that Jordan mentioned. They're trying to take market share in banking. I think they take market share from Gen Z over the years. Yeah, I mean, so now Robinhood is competing with, of all, wait for it, SoFi. So it's like, how dare they? So yeah, if the focus is Gen Z, it was funny. Like I did like a quick poll of my class and I was like, raise your hand if you use Robinhood. And I would say it was like 20% of the class, maybe 25% of the class, and they're 19 years old. And then I said, raise your hand if you use other than Robinhood. And it was probably like 60%. And then the rest, like, just don't have a brokerage, don't invest or anything like that. Interesting question here. Did you check the 10-year? Do you think it will repeat the same behavior of last September? Mortgages are going up again too. Let's take a look, friend. Interesting. Oh, yeah, 10 years going down. And then it popped back up. So no, I didn't notice this. So this is over the last how many days? Hang on. So I'm pulling up the TNX. So it's actually going up. That's interesting. Where's the 5-year at FVX? Same thing. Oh, now I'm seeing what Cooper was talking about. U.S. Mall's economic lifeline for Ally Argentina. Very interesting. No, I didn't notice that. I want to see the long curve. Yeah, wow, that's up too. So this is pretty interesting because it doesn't matter, frankly, like the Fed sets the rate. Like, yeah, that's important. But at the end of the day, the market is going to determine what the rate is. So always remember, like the Fed sets the benchmark and everything gets priced off of that. But ultimately, like the buying and selling, supply and demand is what actually creates the rate. So FVX was on a downward trend. FVX is the 5-year, and that was on a downward trend, I think, in anticipation of rates. But maybe the response, the reason why it's going up is because they thought rates should have been cut more. That could be what happened. Maybe they wanted a 50 basis point cut. Yeah, that's interesting. I mean, look, on the net, you could look at the trend. Over the last year, the FVX has gone from 4.59 to 3.69. So it's down pretty significantly, 90 basis points. If you look on a relative basis, that's 30%. So that is pretty significant, and that's definitely a downward trend. Awesome. Thank you, Sam. Yeah, we're all over the place. I love that. I love that we're all over the place. Like, this is great. We're covering like economics, we're covering monetary policy, fiscal policy, stocks, bonds, foreign, domestic, Bitcoin, oil. I mean, we covered the whole gamut here, guys. All right, so I'm going to cut it here. I appreciate all of you as always. Be on the lookout for Friday. New stock that we covered previously. You definitely know it. It has a lot of AI going on for it. So be on the lookout. Make sure to tune in. As always, please like, comment, share, and let's continue to grow the channel. And also, I appreciate come up with some ideas for stocks for me to check out. Maybe some of these other channels are looking at things and you're like, hey, dude, this is being covered heavily. I'm not like going through YouTube as much as you guys are. So please let me know, and you might see it coming up in the future. So have a great evening, everybody, and I will see you again soon. Peace.